What's going on, everybody? It's Jeff here. Welcome back to the channel. Inflation coming in hotter than expected. Market selling off in a strong manner as a result. In this video, now I want to talk about how much investors are starting to price in future rate hikes. Last month, inflation did pull back a little bit. It was 8.1 expectation. It registered at an 8.3 from the previous month of an 8.5. UBS had predicted that inflation was going to peak. Obviously, we reached another high of an 8.6 as of today. We're going to go over some of those numbers in a little bit, but I really want to talk about where the market is going to continue to go if it stays on its same path. And what I mean by that is the fact that the Fed is only set to raise rates in a very, very slow manner. Generally speaking, when the Fed is going to raise interest rates in order to fight inflation, the Fed fund rate needs to be higher than the inflationary rate. We're sitting at 8.6% with a Fed fund rate that is just at 1%, set to go up to 1.5% in just a few days. You can see how big of a gap there is. Take a look at this headline. Stocks head for weekly losses after inflation soars by most since 1981. We talk about the rampant inflation in the 70s and the early 80s. My father's first interest or mortgage rate when he bought his home in 1982 was 13.5%. All right, so you can see that it's serious imbalance that we are at. And like I said, you just continue to see the market slowly trickle. The volume is pulling out of it. Inside the group, I continue to make a watch list every single day. We're waking up even every day. I've talked about some of these long positions. I want to slowly add Amazon getting back down to $100. Puts have been paying very, very well. The volatility has been down a little bit. The volume's been down a little bit, which means some of those, quick, massive gains really aren't there. However, it's really nice to be able to minimize some of your risk. And that, like I said, the premiums are not moving as quickly as they were going forward. Puts on the SPY paid yesterday, called for under 407, today under 394, right at the open. Very, very nice, easy plays to continue our day and really just wait for the opportunity to be able to build that lasting long portfolio again and ride the next wave to the upside. We just really aren't there. So let's talk a little bit about where the SPY sits. We finally, like I said, broke out of that 407 to 417 channel. You zoom out on a daily, now we have a massive gap to the upside, and we're looking to test that same resistance level between that 380 and 385. And unfortunately, we made a lower high. Are we going to make a lower low? Really confirming that continued downtrend. Zoom out to the weekly here. We have a couple different areas of support, as you can see from pre-COVID, that 338, 340 area, as well as right up here at about that 358 to 360 area, if we cleanly break through that 385. And as you can see from the weekly, we've been dancing at it for quite some time, really only a matter of time. Now let's talk about how much these rates are being priced in as of right now. So you talk about June, it's completely got the 50%. They're starting to price in a 50 basis point hike. They're starting to potentially hike in a 75 basis point hike. Now, last month, Jerome Powell had stated, you got 50 for June, you got 50 for July, and we're going to see where that goes in September. Fed President Bostic had actually suggested that in September, they take a break, they take a pause. I think they're a little bit late to the punch. I think it really should have been a massive 1.5% out of the gate. Get the market to pull back hard. Okay, it's much easier when it just comes, pulls down hard instead of the slow trend like we were seeing. So you're right here in June, you're seeing that 50 to 75. Go back even further. Now you're starting to see another 50 to 75. But when you get to September, now you're also seeing again a 50 to 75, bringing the total Fed fund rate anywhere between 2.5 to 2 and 0.75%. Currently, we're sitting at 1% as of right now. Their target still is to get to that 3%. You're already seeing some of that 3.5% priced in. Reason being for this, and this is where I believe the Fed is going to have to really ramp up how much they raise these interest rates, is because the prices just are not subsiding as of yet. We've already heard these earnings, okay, from some of these retail stores saying, listen, we haven't even passed off some of our added expenses on to the consumer as of yet. If you take a look at the consumer price index that came in, you look at these three numbers I have highlighted right here massive gains month over month, leading, look at that fuel, 16.9%, over 100% for the year. We were 1% overall month over month. That is a 12% annualized inflation rate if this continues. Okay, 8.6%. We continue to go higher. The Fed is going to run into a position where they need to. The problem that the Fed has right now, let alone being at midterms, okay, is that we have a massive amount of debt that we pay interest on. Okay, and as that Fed fund rate continues to rise, so does our monthly our interest payments. Okay, how much we pay in interest? I think it was up to about $900 million a day right now. They're paying in interest. So it gets to a point to where they can only raise them so much. The economy can only slow down so much. They're getting less sales tax, less income tax as layoff goes up. However, now they're paying more in interest rates, and we just run a bigger and bigger deficit. It comes to a point to where you're never going to be able to get out of this. It's very easy for us to look back in hindsight and see the amount of debt that we're in right now and say our kids and my grandchildren are going to be paying this and have to deal with this, unfortunately. However, it's not quite realized to, I guess, the officials right in charge right now who's running the Fed, that this is how it is going to be for the short term. So like I said, we've got FOMC next week. Okay, that 2-day meeting. Expect them to continue that at 50 basis point hikes. If they continue that 50 basis point hikes, it's probably going to run very similar to the pattern. We get a little bit of pop that it's confirmation. If they go to 75 basis points, the market really hasn't priced that in as of just yet. However, inflation coming in hotter, I don't know if that's completely off the table. Jerome Powell has continued to state or change his mind as we move on even further. So guys, that is going to be it for this video. Continue to take it slow. Watch for some of these good positions. Like I said, that PE ratio just keeps on going down. And no matter what is happening, if you have cash on the sidelines, just remember that when things ran up in 2021, actually in the end of 2020, all the way through 2021, there's a lot of people saying, oh, and I've talked about this, next time I'll be ready. Next time I'll be ready. Well, these are the times when the market pulls back, wait for that opportunity. Amazon's getting back down to a critical, price point close to that $100. Okay, a company as massive as Amazon, people ride some of these gains all the way back up. Just be patient. That's it for this video, guys. I'll see you in the next one.